The BRRRR investing method is a fantastic way to really make your money work for you rather than working for money. Think of it like long-term house flipping. Basically, you are buying rundown properties, fixing them up, renting them out, and then refinancing to get your initial investment back. Hi, my name is Monahan. I'm a real estate agent in Portland, Oregon, and today let's talk about one of the best ways of investing in rental real estate, the BRRRR method. If you enjoy the video, please drop a like and subscribe, as I produce real estate and personal finance related content weekly. So with that out of the way, let's talk about the first step in the BRRRR acronym. The B in BRRRR stands for buy. Now this may seem extremely obvious, but if you mess up this simple step, there is no going back. For the BRRRR method, you have to think of yourself as a house flipper. You're going to be holding long-term flip properties. You're going to be aiming for C-class houses in B-class neighborhoods. If you don't know how about these neighborhoods and building classes, check out my video on how to identify good locations in rental real estate in the description below and in the top right of the video. Anyways, when looking for houses, you want to go into a neighborhood where most of the houses are pretty well kept, and you want to find some of the worst properties in that neighborhood. You know what I'm talking about, the ones with the overgrown grass in the front yard and the ones that have that rusty pickup truck on the driveway. It is extremely important while considering a property to analyze it as you would a regular deal. Calculate how much you think it's going to rent for after you renovate it based on the comps near the property. Calculate how much it's going to cash flow with a 75% loan for the average house price with similar specs. The whole goal behind the BRRRR method is to take out all of the money you initially put into the property when you refinance it, basically making it completely free. So you're gonna need to do a few calculations. Estimate how much you think the renovations for the property are going to be using high ROI repairs, return on investment repairs and renovations, like the kitchen and bathrooms. Add that to the purchase price and see if that's over 75% of average house prices in the area with similar specifications. The reason why I use that 75% figure is because most lenders will finance 75% of the value of the property. So you want to make sure you're not too far above that 75% figure, as fees associated with refinancing will eat up your money. To buy the property, I would recommend doing it in cash, as getting a traditional mortgage is going to be extremely hard, if not straight up impossible, on a fixer-upper property. Although you can use other forms of financing, like a hard money loan, private loan, seller financing, etc., to get the initial money to purchase the property. However, those forms are a bit riskier, as you're going to have debt from the get-go, and if the property isn't appraised for as much as you thought it would, you could be in some big trouble if you don't have any other money saved. The first R that I'm going to talk about here in the BRRRR acronym is rehab. In the rehab stage, you're going to want to try and add as much value as possible to the property for as cheap as possible. You're going to want to make the property as renter-proof and valuable as possible without spending a ton of money. Here are a few things I would recommend doing to add as much value as possible without having to spend a fortune. You have some new paint, maybe replace the flooring, have laminate flooring instead of wood, add a washer dryer, boost the curb appeal, painting the kitchen cabinets that are already there, do a cheap kitchen backsplash, have some bathroom tile, upgrade the fixtures, remove dated features, replace lighting, fix walkways and driveways. These are just a few ways you can add value to your property without spending a fortune. The most important thing to remember is you're trying to add as much value to the property as possible, so please do not go overboard. You're trying to yield as much of an increase to the property value when compared to the expense. You shouldn't be doing any high cost and luxury renovations, and before you even consider buying the house, you should rule it out if it needs any high-end fixes, aka structural damage. We want to rent our rental-proof homes, which our tenants will be happy with, not high-end vacation rentals, and definitely not the bare minimum. Most importantly, and I know it's simple, just make the house look clean. It's the clear difference between when you first bought the property. in a not so great state to when you put it on the market should be extremely noticeable, especially the front yard and the curb appeal. A great first impression for possible renters and the appraiser later down the line will be extremely important, all while being pretty cheap. The second R is rent. After you renovate the property, it's time to rent it out. However, you must screen your tenants properly. You're going to want to run a credit and background check on every potential tenant, and I would also recommend contacting their employer and previous landlords to see what they have to say about them. After these important aspects are done, you can go from there. Before you've even bought the property, you should have already run the numbers on what your property could potentially rent for. You should have made sure it comes out cash flow positive when you have a mortgage on it, which will be 75% of its appraised value. So, for example, let's say the home price you think your house is going to appraise for after renovations is $100,000 and the rent you think you're going to charge is $1,000. So you're going to have a $75,000 loan, 30 years fixed at a 4% interest rate for this example, and that's $358 a month for the mortgage on top of your other expenses. You must make sure that that extra $358 a month you're going to have to pay is still making your property cash flow positive, and if not, this property is not worth it. Of course, what you think it could appraise for could be lower or even sometimes higher than what you think, so I'd always recommend sticking to conservative estimates on both the rent and appraised final price. The third and second to last R in the BRRRR method is refinance. After you've rented out the property, it's time to look at refinancing. This is the meat and potatoes of the BRRRR method and will make or break your investment. Some banks will let you refinance after you have a renter in the renovations, although some will wait to up to a year after you initially purchase the property. Be sure to shop around a few different banks to get the best rate and the lowest times until the bank will lend based on the appraised value, not how much money you have in the property. I would recommend asking other people who perform the BRRRR method what bank they use, and you're definitely sure to get some amazing info. The reason why the refinance aspect of the process is crucial is because this is where you make your money. Let me show you two different examples with very different outcomes. $75,000 total invested, the property appraises for $75,000, you get $56,250 out of the property. This means you still have $18,750 left in the property. Of course, this isn't actually that bad because you're still cash flowing $200 a month. You're making a 13% return on your investment, even on a quote-unquote bad deal. However, this means you're still short a little bit of money to repeat this process. Let's look at another example. So you have your $75,000 totally invested, your property appraises for $95,000, and you get $71,250 out of the property. This now means that you only have $3,750 left in the deal. This is amazing, as if you're cash flowing $200 a month, you'll be making a 64% return on your investment, rather than 13% on the bad deal, and rather than an average of 7% in the stock market. This is the power of the BRRRR method. The last I'm just going to briefly touch on here is repeat. Yeah, you heard it, rinse and repeat. If you do the BRRRR strategy right, you should have a cash flowing property for little or nothing down after only 4 to 6 months of time. As you can see, the BRRRR strategy is a fantastic way, and in my opinion, the best way to build wealth in long-term hold rental real estate. Thank you all so much for watching. I hope you learned at least a thing or two about the BRRRR method. Please don't forget to like the video if you liked it, and be sure to subscribe for weekly real estate and personal finance related content. Until next time, see ya.